All right, let's see. I think we are live. Okay, I think we're live. Hari, let's talk about a few things. Well, first, welcome everybody, whoever is watching this later. Right now, we're recording this on July 30th, Saturday. Right now, where I'm sitting in the East Coast of the U.S. It's 5 p.m. 5:15. Um, Let's get started. So we identified sort of three topics that we want to talk about. Facebook Meta, I think earnings season has begun, and it's interesting to see these numbers come out of these big tech companies. And so we want to talk about Facebook, and then Federal Reserve raising interest rates. It happened this week. The Federal Reserve committee met this week on Wednesday and decided to raise interest rates 75 basis points. We want to talk about that. And lastly, the Inflation Reduction Act. Is that right, Hari? What is
Yeah,
it? Inflation Reduction Act?
the Inflation Act is what it's actually doing. But
Inflation Act. So let's talk about those three things. So let's get started. So Facebook. Um, Facebook earnings. Kick us off with that topic, Hari.
yeah, so a couple of interesting things is that Facebook a couple of quarters ago, I think, announced that they were going to have some revenue. Their revenue was going to start to take a hit because of Apple had implemented some privacy things that prevented them from doing some advertising, like their targeted advertising, and that really was going to hurt them over the next quarters. And then last quarter, they didn't seem to have much of an impact, but this quarter, what ended up happening was they actually posted their first revenue decline year over year for that quarter, and they'd also announced that they were going to do some hiring freezes and that they would probably have some attrition in their employment because they were going to try and get rid of some of the lower performing employees and the people who are taking too much vacation. So I think the story behind all of that is that they're saying that the advertisers are not really spending any money anymore on the platform because not anymore, but they're cutting back because of inflation and because consumers are not really spending money in the U.S. like they were a year ago or 2 years ago. That the concern is that largely because of inflation, that they're cutting back their advertising also. So a lot of this is kind of like turning into the perfect storm, but there's an underlying current here because you and I talk about moats all the time and how a moat can protect a company from competitors and things like that. But there's two things that are kind of hurting Facebook more than they're not hiding from it. I shouldn't make it sound like they are, but one of those is that Instagram is getting hurt by a lot of what's happening on TikTok. So a lot of younger viewers, which is their targeted demographic, is moving over to TikTok, and it's a lot more video based. So Instagram tried to copy some of the things that Snapchat has done, which their Instagram stories, kind of you click on something and it disappears over 24 hours. It's a short, like, animated kind of, picture, but Instagram's trying to adopt a lot more video stuff. And that is kind of because TikTok is eating their lunch right now. So there's a lot of things that are going on here. And I think, my feeling is that there is actually going to be some disruption in Facebook's moat because they're no longer going to be the king of social media. They're going to be sharing space and time, and eyeballs with TikTok.
So a question that comes to my mind is that when we talk about the checklist, right? We go through competitive edge and we outline a few of them, right? We talk about what are some, like, big capex as one of the moats. We talk about intellectual property as another one. Switching costs is another one. And then this, when it comes to social media, the big one there is network effect.
Right.
Right. And it's almost like, back 10 years ago, it was one of the most impenetrable moats. once you have the network effect going, it just compounds itself and it just grows exponentially.
Right.
Now, I guess, are you suggesting that you're seeing, I guess, so you're saying that we're seeing some cracks here on that particular competitive edge.
Right.
I guess, I mean, it's not surprising. The kids are on TikTok. Facebook is sort of dying off. But what's the lesson there for us, right? I mean, it's like once you have a company that's like really, really, taking full advantage of the network effect, it was one of those things where you said, okay, well, this is just like a buy and hold thing. Just
Right.
buy and hold. This is almost like one of the most impenetrable modes. But then you're seeing cracks of this now. Arguably, the best company that knew how to utilize this particular mode. What's the takeaway for us?
Well, I think it's that, it's very easy to to assess a moat as being something that's stronger than it actually is. And in the case of, it's almost like an easy come, easy go kind of thing, right? Facebook was able to build up a moat very quickly and very, powerful, because they had a social media, quote, almost monopoly, right? Twitter has not been profitable. Snapchat hasn't been profitable. And a lot of people kind of flocked. And to your point about the network effects, they have a lot of people on Instagram that are, celebrity types who have built an entire brand around their Instagram following. And in some cases have become, billionaires with a B, off of it. Right. And they're not going to be happy if Instagram is going to start messing with that, following. And what'll end up happening is either they switch to something else and then they take all their users with them, and then Instagram becomes less what it was, right? And there are other apps right now that I think are occupying a lot of people's mental focus, like TikTok, and then there's smaller apps that are kind of taking up the thing that made Instagram was like just looking at people's photos, on a timeline, right? Now that may go away or may get interrupted and people may switch off of that. And so the casual user may not, be on there either, right? So what this ends up doing is it erodes that moat. And now if you don't have the people on there, the quote unquote, celebrity influencer people, and you don't have the casual people, well, then advertisers will disappear too, right? So this is how you are reversing that effect, right? Theoretically, I don't think it's going to happen overnight, right? I think it'll take a long, long time, but this is slowly what happens when a company loses some of its edge.
It's interesting because people talk about like the network effect and how the exponential growth, right? Facebook and all these companies that utilize the network effect grew exponentially.
Yep.
That rule might apply the same way on the way down.
Right.
So, I mean, that's kind of interesting how a lot of the users are switching over to TikTok, and we could probably do a whole segment on like TikTok and what that, But if people are switching away from Facebook, I mean, I just wonder what that drop is going to look like. It's interesting.
I would love to hear from people like what their experience was with Facebook, and like if they can comment in the in the YouTube chat, or if they're listening live, to message us. But what I would love to hear is how people are seeing it in their own circle of friends, because I know a lot of people who were on Facebook 10 years ago. And when I search for them now in Facebook to look up what's going on with them, I don't see they've like deleted their account. Right. And it's not like a small percentage. I'm talking like, 25% of the people that was on have gone. Right. So
Yeah.
I'm curious what will happen there.
It seems to me that what we are seeing right now with Facebook, this revenue drop, is almost like a lagging indicator, actually, of the actual underlying user. Because
Right.
you and I know, and I think most people know that are listening to this podcast, know that Facebook has been on decline for a while when it comes to,
Yeah.
Becoming this kind of digital town square. Like
Right.
it sort of it had its heyday, and then it's now on its way out. And we
Yep.
all know that, but I feel like there's a bit of a lag here, I feel like, and we're seeing kind of the signs of this. And yeah, that's sort of the one angle. Another angle is, Zuckerberg obviously making big bets with VR and his new venture in the spatial computing realm. Um, and then there's like a whole story with Sandberg, what happened there. She's been with the company for a while. If
Yeah.
a chief exec, one of the C-suites leave, that's kind of a big deal. And so I
Right.
think it's just compounding, and perhaps it's an evidence of something that's sort of not going so well in the company. Um, but yeah, I mean, I personally, I'm not interested and invested in Facebook.
Right.
Um, but I think it'll be interesting to see how this all, pans out.
Yeah, I mean, I think if you are somebody who is an investor in Facebook, I would be curious to hear your thoughts. Comment on that if you're looking at it as a potential investment. I certainly haven't, but I would be really curious to see if they start doing some sort of buyback. They generate a ton of free cash flow. Would they start buying back shares at a aggressive clip? Because even if their revenue stays stable and they continue to buybacks, right? I think you can see a huge growth in the price, even if the overall, market cap doesn't, necessarily move anywhere. So
It's interesting because once you start doing buybacks, you're sort of declaring to the world that you're sort of like hit its peak. You don't
yeah,
know what to do with your money, and so you're now going to revert to this playbook of buying back shares, which is sort of the playbook of companies that are very mature and
yeah,
very much cash flow positive. So it's sort of like declaring to the investor base that we're sort of at that at that stage of life, a company life
right.
cycle. I personally don't think that will happen, but
Well, I think they're still thinking like a growth company, and they're going to spend money on VR. And to be honest with you, I just don't think it's going to happen. Like VR is not the next platform that everybody is trying to make it out to be. Like it's it's one of those things that everybody thinks is fun for like party games and kind of that kind of stuff. But I don't think it's going to take over gaming. It's not going to take over. People aren't just going to come home and put on VR headsets. Like you can browse Facebook, on the bus, on pretty much anywhere, but you're not going to walk around and put on a VR headset unless you're at home.
yeah,
So
yeah, we can talk about the VR stuff. That's some people that listen to this may know. Um, I run a company that has VR as one of the elements in my business, and I can attest to that. Even though there has been many generations of VR, the form factor hasn't really changed all that much, and there's a very particular niche where VR plays a role. To be a general computing platform, there's so much more work to do. Many,
yeah,
many years of work to do. Okay, let's move on to the next topic. Federal
yeah,
Reserve raises interest rates. Talk us through that, Hari.
yeah. So I think it was Wednesday this week that they announced that they increased it by 75 basis points. So that means uh, increasing it by 0.75%. So we are now what that generally means is that's the intra-bank borrowing rate. So that's the banks can borrow money from the Federal Reserve at that interest rate. And what that allows them to do is take that money and then loan it to people as part of their their business, right? And so they're able to you know uh, but at the at a higher interest rate so that they can make a profit, right? So the net difference between what they have to owe the Federal Reserve and what they can charge for people is what they make, right? So typically, when interest rates are very low, that means that more people are borrowing at higher valuations because it's cheaper, right? And we talked a lot about this last week, so I won't go back into all of the detail there, but you and I talked about we were expecting another fairly significant rise, and 0.75 basis, 75 basis points is a very sizable increase, and they've done it now. That's the second one in a row. And this third topic we'll talk about in a minute, um, is probably going to increase the amount of inflation that we see in in the economy. Will they have to continue to do this? I think is the other question, right? Because if you raise interest rates this much, that means housing, has started to decline in valuation, and new housing starts, which is how many new homes are being built, is declining, and then the real estate market is starting to show. So they're lagging indicators, because when the Federal Reserve raises interest rates, it then takes time for the banks to then raise their rates, and then it takes time for that to affect housing, right? And so we're starting to see that 6 months after the Fed started talking about interest rates going up, and we're finally seeing that impact.
Yeah. What I find really interesting about this time around, in particular, this 75 basis points, just a side commentary on this whole financial market, today's market. Everybody has turned into like an armchair macroeconomist.
Including you and I.
Everybody has turned into like an armchair macroeconomist. Everybody has turned into an armchair, like a hedge fund manager, a day trader, and speculator. And this is, I think, what happens when government like manipulates the market in ways that it just makes everyone a speculator, and this is kind of the danger of it. And what we have seen this week is really interesting. Once the Federal Reserve actually announced the rate hike, the market rallied. And why did it rally? It's because people think that they're going to pivot, right? And so like it doesn't matter like the fundamentals of the business anymore. Like the whole macro environment just dictates the entire financial market. And
Yeah.
when I say a macro environment, it's mostly just like Federal Reserve. It comes down to a group of elders that decide the value of money. And so
Right.
like this whole situation to me is very sad and kind of cruel. And it was just so funny this week. It's just everybody is expecting the pivot, and the tone of the Federal Reserve Chairman Jerome Powell, the way he talks about it, and it's like people are reading into it, and there's probably a lot of thought that goes into exact word that he uses during the conference to signal kind of hawkish or dovish kind of sentiment.
Yep.
And yeah, it's just a side comment on that, as somebody that would like to focus on the actual business. It makes it very difficult to do that when the environment that we find ourselves in is being subjugated to these sort of market manipulation.
Yeah, I mean, I don't disagree with any of that, in terms of how it's being manipulated into to protect. This is all completely self-inflicted, right? We have a government that is not willing to open up energy production, which is, like we talked about last week, is causing a tremendous amount of pain in the oil and gas sector, and that's causing a lot of the downstream expenses, right? I don't know if you guys have followed us, but we have a blog that we write at blog.valueinvestor.org, and love for you all to check it out. But at that, we talked about one of these, that the inflation rate is about 10% overall, but when you look at it, energy is about 60% of that, is 60% increase. Food is like 11%, so it's barely above the inflation rate. If they really were serious about doing this, and this will be also the next topic we talk about, they would actually focus on increasing energy production domestically, right? And that is what would affect this more than raising interest rates is good for trying to slow things down, but there's a danger here in that every American is now going to have to pay more in interest on $30 trillion in debt that we now owe, right? Anytime we borrow money, it's going to be at a higher interest rate, because that's what the interest rate is affected by. So there are serious ramifications. And if you read, the Wall Street Journal was actually talking about this week. There's actually the hedges, there are various instruments that you can use to bet on what the interest rate is going to be in a year. And people are actually thinking the interest rates will come back down. Once
December,
yeah,
December,
yeah,
January.
yeah. Once they get interest rates under control again, they're going to try and raise, lower inflation under control. They're going to try and raise the interest or lower the interest rate back to historical lows like they have, and they kind of have to because they're paying too much in debt, right? So, but yeah, it's going to be. I don't think this is going to be enough to slow it down. I think we're going to have several more interest rate increases before the end of the year.
I agree. I agree. Yeah, I think it's just going to be really interesting to see how things unfold. Yeah. So stay tuned. Stay tuned for that. Let's move on to the third topic.
Yeah. So I think we had mentioned this. There was two bills passed that I think are very interesting. The first one is 430-ish billion-dollar Inflation Reduction Act, which has a couple things in it that are actually going to promote what's called stagflation. So the first is that it's a lot of green energy policies that are being implemented.
Hold on a second. Was it passed or was it proposed?
It is proposed, but
Proposed.
it is expected to pass because the Senate has approved it,
I see.
and so the House is already controlled by Democrats, so they're in favor of it. So there's very little risk that it won't pass. But the what it's essentially going to do is there's a lot of green energy spending that's going to be part of that, which is inflationary by nature, right? Anytime you're spending more money that wasn't planned, right? That is inflationary. And then the second part of it is there's a minimum corporate tax rate of 15% that's installed with that. So for many companies, that's actually an interest tax increase, right? And what that'll do is
just to add a finer point on that, it's imposing 15% corporate minimum tax, and the reason why this is in place is because many companies don't pay corporate tax because they have all these kind of accounting kind of rules, and you can carry over losses and things like that. Just let me just finish this. Impose 15% corporate minimum tax rate for companies with higher than $1 billion in annual revenue.
Right. So let's think about that for a second, what that actually means, right? When you raise the tax rate for anybody, right? Basic economics will tell you that the company doesn't ever pay taxes, right? It's always the end user, the end consumer that actually pays the taxes, right? And the reason for that is they raise their revenue to actually offset whatever loss they're making on the tax revenue, right? Because they're gonna pay for it by raising that in the long run, right? So what'll end up happening is it's actually increasing the inflation by doing so, right? But the other part of it is it actually decreases investment because now you have less money to spend. In general, like these tax credits that they were using to get below that 15%, they were taking that money and then reinvesting it in the economy or doing things to help and bolster their own businesses, right? And so what's going to happen is you're taking away, you're basically in one foul swoop, you're taking away both sides of the equation, right? And then the green energy stuff is essentially pouring money into the economy that wasn't planned for, right? Nobody's actually spending $400 billion in green energy. It's now being, it's over 10 years, but it's being pushed into the economy that didn't exist before.
Yeah, I think there's a few things about the climate, the green energy stuff. There's like a bunch of subsidies that's going to go out with EV vehicles and things like that,
Yep.
which to me is just like a corporate welfare thing. And
Yep.
I was just thinking about this because in healthcare, where you're in the industry that you're a doctor, and the industry that I am in as well, there are a bunch of these kind of subset of healthcare systems that have government. It was well intentioned. Like government programs were installed to help promote kind of some kind of like a program that allowed like I think a good example of this is actually dialysis. You see
Yep.
dialysis clinics everywhere, and you have like DaVita Healthcare, right? That basically monopolize the space. And if you look at if you look at some of the innovation that could have happened in that space, there was like an at-home like dialysis, procedures and things like that you could have done at home, and there was like all these different innovation that was happening. But because government initially promoted, patients to go to dialysis clinic, the innovation that could have happened didn't really materialize because on the surface, from a customer standpoint, going to dialysis clinic was cheaper. And so why would I spend that extra, whatever, time and energies to look for some innovative solution when the status quo is cheaper? But if you actually reveal the curtains, it's cheaper because of the subsidies. So it's actually stifling innovation. I think something like this could happen here with green energy. It's good intention of like, transitioning to more renewable, more green energy, but it's again like this market manipulation where the market isn't able to sort out the true winner versus like
Mhm.
the loser. So I personally am worried about that. In addition to the inflation.
Right. And I'll just add one thing to the dialysis question or story here, because a lot of people are probably very unfamiliar with it. But the vast majority of patients who are on dialysis don't actually need it 3 days a week. But because it's subsidized, it's also paid for 3 days a week. And so what you end up doing is you actually have people coming to the clinic when they don't need it, right? And it ends up causing, because the clinic can get paid for doing it, right? And so a lot of these people who are now, if you've ever seen anybody who's on dialysis, the day that they get dialysis, the day after, they're basically like wiped out. It's a pretty stressful thing on your body. And then you come back 2 days later and have to do it all again. Right. So you're not really doing, and it's a 6-8 hour affair, right, that you have to spend at the clinic, right? So because of that, you're taking these people basically out of the workforce because they're going to it's a full-time job to be dialyzed, right? And because you didn't actually let the market kind of dictate that and what actually the patient needed, it sounds good on paper that you're trying to help these people, but what you ended up doing was actually hurting them more, by essentially making them, completely dependent on, that money, right? And like you said, it's a great parallel to what we'll see in the green energy, world.
Yeah. So I sort of worry about that. Um, yeah. And what else? Is there anything else you want to talk about here?
Yeah,
Inflation?
real fast. There's another act that's being bandied about, and it may already have passed. I'm not 100% sure, but it's passed the Senate, which is the CHIPS Act,
Oh yeah.
um, and it's like the Chips and Research Act or something like that. So it's a well-intentioned thing that I think is where $25 billion is being spent to increase microchip production in the U.S. Right, and I think from a economic and national security standpoint, it is a great thing for us to do as a country, because if China takes over Taiwan and Taiwan destroys their chip manufacturing, we're all now dependent on China for chips, right? And China is way behind in terms of chips, but they have, from a technological standpoint, but they have they have a lot of manufacturing capacity, which the U.S. doesn't. The problem is that there's also $200 billion in there for research and development. Now, this is, again, like you said, corporate welfare and putting money into universities in terms of like, universities are going to get a huge chunk of this money to essentially spend on research and development. Now, my problem with that is that the chip companies make tons of money. They should spend their own money on research and development, right? The US is far ahead. Putting more money into this is not going to yield better results. It's just going to yield put inflation into the economy, because people are going to spend this money in ways that they didn't really earn it, right? But if Intel and AMD spent that money, they'd be focused on profits, right? But if Intel and AMD wanted to work with universities, I have no problem with that. But I don't think we should be granting universities money, because that's not where that's not going to be the most efficient use of that capital, right?
Yeah, there are a few things that come to mind immediately. First is that universities are they're rich.
Yeah.
They're rich.
Yeah.
I mean, if you look at their endowment, they're rich. They're like hedge funds. I
Right.
mean, you should go look up. I mean, people that are listening to this, go look up like Harvard Endowment. They're running $30 billion of asset under management. They're basically a hedge fund.
Yeah.
Okay, so it's not like they don't have money. That's number one. Number two is what I worry about is actually like some of the espionage that's been happening all across these high
Mhm.
level institutions.
Yep.
I mean, it's like every 12 hours you have an espionage that's caught from China or some other country. It's mostly China. It's like Chinese espionage that's happening all across the country to steal, these intellectual properties. I worry about that, and I worry that some of this money that's going to be injected into these universities, I just don't know if they're going to yield much results, given those things with like um, sort of the inefficiencies of university systems and research apparatus.
Yep.
It is the best we have, and I think you're right. It's like very well intentioned, but I just wonder if there's guardrails and safety measures in place so that we can take into account the results, like because it's taxpayer, it's you and my money going into this, or it's future money that our kids have to pay.
Yep.
And I would just love to see some accountability around this. But it's
Well,
it's something it's something that's going to hard to ask for in government in most government programs, I think.
and not only that though, it's also inflationary, right? You're putting money into the economy when it doesn't need to be there, right? The economy's already on fire right now, and you're just pouring gasoline on it. I mean, in $650 billion that was just spent that wasn't going to be spent before, right? And I think of all of that, only maybe 25 billion actually needed to be spent, you know?
Yeah.
So
I mean,
it's an amazing amount of money that's being thrown into this, right?
so I guess just last question to you is like, okay, let's focus on semiconductor industry for a second. Like, what do you do? What is
To
the right path? What is the right path to let you know American or sort of Western alliance companies to be able to have their own, foundries and manufacturing facilities and all those supply chain? Like, what is the right way to do it?
Yeah, I what I would have done is I would have given them a tax break for building chip plants in the U.S., which this does, right? And I would have given them I wouldn't have given them a subsidy. I would have just given them a tax break with a long tail, like 10 or 15 years, and and have that be kind of what drives their innovation, right? Because if you look, Taiwan has TSMC, which is where most of these chips are being built right now, and it's all concentrated uh, in the in Taiwan. TSMC actually started building in the U.S. Under Trump, and now it's going to continue with this. So I would have just said give them the incentives that would have done it without costing taxpayers any money, right? Because honestly, if they spend that money, it's going to create a bunch of jobs. Those people will pay taxes on their income, and you solve the problem, right? I think that's the right way to do it instead of outright giving them cash, right?
Yeah. I mean, it's sort of like Federal Reserve is trying to tame the inflation, and then if some
Yeah,
of these like this bill, chip bill, and then the was it Inflation Reduction Act, if that gets
yeah,
passed, it's
yeah,
basically like you're sort of undoing a lot of the work that the
yeah.
Fed
And
is
I think
trying to do.
I think I was hopeful that we would have inflation under control by the end of the year, but now I'm feeling like it's going to go past the end of the year because we're now going to pour more gasoline into the fire right now. So
Hmm.
we'll see. I mean, maybe it'll start coming under control just because energy prices will start, like demand will start coming down on its own, right? And that may have more impact than anything that inflation or the Fed does.
Hmm. Yeah. What is just one last question? We're almost at time. If you think that inflation, let's actually zoom in on this. You think that inflation is going to continue at like 7, 8%, 9% for the next few months?
I do. I think it's going to be less than the the peak, but it's going to be still like 7%. And the reason for that is, one, I think oil and gas has already come down a little bit. So now you're seeing at the peak it was $5 a gallon. Now it's closer to $4. I actually filled up it for $3.50 today, which is
Really
yeah. So I think it has come down somewhat.
interesting.
But I think what's happening is still that shock is going to still take some time to get all the way through, right? Because companies are going to have to wade through all of that extra expense for gasoline, for transporting goods, for plastics that they use for manufacturing. All of that will take time, right? And I just don't think it's going to happen fast enough to tame it down. These things just take time to play out. And then I think the other part of it is that's going to happen is we're going to start seeing layoffs from companies.
Yeah.
And then that'll actually have the biggest impact, because job layoffs, if you look at the 2008 recession, that was actually one of the last indicators. One of the lagging indicators of the recession was actually the job market. It took a lot longer than the other shocks that happened. And I think we're going to start seeing those layoffs towards the end of the year as companies try to keep their balance sheets, controlled.
Mm-hmm. I mean, we're starting to see that happening. I mean, yeah, definitely. That makes a lot of sense. I am particularly interested in looking at that particular chart of unemployment. I think that's going to be a really, really telling indicator of where we are in this cycle. So my eyes are on that right now. Cool. I think that's about covers it. Anything else you want to talk about?
No, I just like to remind everybody that we are trying to get a lot of stuff back content wise out the door, and what would help us out a lot is if you like, comment, and subscribe on this on these. If you're listening to this on YouTube, share it with friends if you can. That will help us out with the algorithm. And I think in the next few weeks we're going to have a bunch of announcements to make in terms of new stuff. But in the meantime, if you're interested in getting onto the podcast Slack channel, email us at info@valueinvestor.org, and we'll happy to add you there, where you can ask us questions and get involved with the community. Yeah, I mean, anything else you want to add to that?
No, I think that's it. Yeah. Hope you guys enjoyed this. We'll definitely be, we'll be recording more regularly, and like Hari said, we have a few things that we want to launch in the next couple of weeks. So stay tuned for that. And thank you guys for listening. And I'll see you guys in the next episode. All right.